Hello and welcome back to the Note. And we've had a week dominated by the European Central Bank. On Thursday, of course, they announced a very dramatic package of monetary policy measures which went quite a lot further than the market had expected, but they also surprised people by apparently ruling out further interest rate cuts. Let's see, now that we've had 2 full trading days here in the States to react to this, where the market stands. Now, first of all, let's take a look at eurozone banks. Very central to the ECB's concerns. The eurozone's banking system has been a critical source of weakness since well before the crisis. It entered the crisis in a much more bloated condition even than the US. And you can see that there was a serious crisis of confidence in European banks in the first few weeks of this year. One of the more surprising elements of what the ECB announced was a very generous package of term lending facilities for banks. Whatever else central banks may or may not be able to do, they still have a lot of power to deal with the banks that are part of their remit. You can see that this has had a very dramatic effect in assuaging the market's concerns over the health of European banks. That's plainly one big success for the ECB. However, if we now take a look at the effect on currencies, you can see something a little more concerning. What we're looking at here are the exchange rates of the euro and the yen against the dollar over the last 6 months. Bear in mind that there should be a very clear pattern. The Fed here in the US has raised rates in that period, which should strengthen the dollar. Meanwhile, the central banks of Japan and the eurozone have both taken measures that ought to weaken their currencies. But as you can see, after the Bank of Japan went for negative rates in the end of January, we instead saw a very dramatic rise for the yen against the dollar. And now we've also seen a very significant, if somewhat less dramatic, rise for the euro after a monetary easing. That's almost certainly because the ECB did seem to rule out further negative rates from here, but it does also hint at the limits on central banks' power. Market people are worried that there is a limit to how many more assets they can buy under QE programs. They're also worried that there is a limit to how far they can cut rates into negative territory, given that that damages the profits of banks, and the banks are still very fragile. So this is, on the face of it, a very concerning development. Now, if we move to the States, however, we can see from this next chart that it doesn't seem to have had too negative an effect on sentiment here. The S&P 500 is now back above its 200-day moving average, a very strong sign of recovering sentiment. That's the first time that's been true for the whole of this year so far. This rally is now up some 11% from the bottom. And as you can see, even though we're still well below the top from last May, we have had 2 positive rallies of more than 10% in that time. That's why people do try to trade the market. There is money to be made in it, even if most of us who can't afford to do it full time should probably not try. Now, in another interesting development, if we take a look at the 10-year Treasury yield, we're now almost back to 2%. This is another very intriguing example of a central bank taking an important step and seeing the market reacting in almost the opposite way to what might have been predicted. The Fed, of course, raised rates back in December. That should push up bond yields, and instead you saw a very dramatic fall in bond yields. We are now moving back to something more akin to what many investors and what many central banks had in mind 3 months ago. Does that mean that we're going to get a rate rise from the Fed this month? Almost certainly not. The international situation is still far too churned up for them to take that risk. But most economists now, I think correctly, expect that if we can get through the next 3 months without any major alarms on markets, you are going to see further rate rises later this year. That, I think, is where the focus is going to be for the next week or two. We have some more central banks to hear from after yet another major announcement from a central bank which has had a very counterintuitive response. That is where the focus is going to be.